Welcome back to the YouTube channel. Today I got some really crazy news for you guys, and we're going to talk about how U.S. homeowners lost $108.4 billion in home equity this year. This article is basically going over that those with smaller down payments are a great risk of going underwater. So what it's basically talking about first is going into negative equity. Negative equity is basically when you buy a house for $500,000, but the market isn't going upwards, it's going downwards. So you buy it at the peak at 500, and the value, if you could sell it in a year down the road, is going to be like 400, then you're upside down 100,000. And it's not a real tragic issue unless you're going to sell or you want to refinance. Because if you want to refinance, the banks want to see, oh, this is a house that is appreciated, you have equity in it. And so when they refinance you for a lower interest rate, they do not want to do that when the home value is 400,000, but you're actually owing 500 on it. So that's negative equity for you. And this article is basically going about that with higher interest rates. Higher interest rates makes it more unaffordable for most people. So that should bring the prices down. And then it's basically showing us a graph here. And as you can see on the graph, there's some crazy numbers here. So negative equity, California sticks out. Oh my gosh, Seattle, negative 74,000. My home state, negative 33,000 in equity. But when we move more to the East Coast, we actually see Florida plus, we see Texas plus, we see New Mexico plus, and we see some other states around Florida, they have a plus on it. So they actually gain in equity from the last year. So then it's going over this dude here, who's this guy. He lost 50 grand in equity on an investment property. So when you lose money on an investment property, you should never look at it that way because it needs to produce cash flow. And if the cash flow is still there, you're not really worried about it too much. So what I do is when I buy a new house as an investment property, I make sure that my loan amount that I have is smaller than the rental income, so I have a nice little cash flow spread. And so I couldn't care less if the house value drops 50% or 20% because I still make money from it and I'm going to hold it in the long run, so it should come back up again. But the problem with that is that sometimes when home values drop, rental price drop too, and then you have to give your unit out for less money than you actually anticipated, and so you might have to pony up money to keep that rental property. And that is where you're in a situation where you're paying your tenant to live at your house. So I don't think that's a good idea, but hey, this guy clearly tried something. Who knows what he did. So he bought, here we go, he bought a 2-bedroom, 2-bathroom home in Long Beach, California. Yeah, I heard Long Beach, California is pretty hot, but who knows. Also, he has a 30-year fixed mortgage rates and a 3.2 interest rates. Yeah, Airbnb, there's a bunch of problems. I would probably not buy another one again, because if you can't get a permit, that high cash flow that you're kind of expecting isn't going to come through, and so you're going to be in a bunch of hurt. And yeah, there's a bunch of short-term rentals, crackdowns everywhere, even in Las Vegas. So, and here we have another graph showing the Metropolitan, how much they decreased in price. So when we look at some of these prices, that it's way more prominent on the West Coast than the East Coast, that the prices came down on the West Coast is way more. Like San Francisco, 220,000, Oakland 16.1%, or 174,000. Those are crazy numbers, and I could see that would hurt a lot of people when you have that much equity. But I personally don't touch my equity, so I don't really care about it too much. I'm not trying to refinance or pull money out. That seems really tricky. Plus, I have a low interest rate, so I wouldn't really worry about it. So then this article basically goes in and says, what should you do if you fall into a negative equity position? So best thing is that I agree is wait out the crisis. So every month you're paying off your mortgage. So it's just like when you get a car loan and you're basically just going to hold on to it for 5 years and your car loan's only valid for 3 years and you're upside down on it. It doesn't, in a house, it doesn't really matter. In a car, it does matter if you're going to trade it in. But for the most part, I think you're thinking of holding it on and can keep a steady job and some money saved up for an emergency fund. So then it also goes on of saying, consider a special negative equity refinancing loan. So I think those are really hard to come by. If you're in a position where people are in a negative equity position and they want to try to refinance for a lower rate, I don't know how many banks there are that would do that. Let me know in the comments below for any other people that want to view this, what kind of banks they should use. And then here comes the crazy part where we're talking about consider a short sale. I would highly, highly recommend you to check with a financial advisor and your lawyer before doing a short sale. The mortgage company is going to accept a lower payment amount, and you basically walk away from the house. So that is not good on your credit. And yeah, if you do something like that, you're going to be in trouble with the bank and your credit score. So basically, it's a pretty good article. Do I think that that houses are coming down according to this article and the research they did? I do see that. And if you're going to sell now, you should do it now rather than later. But if you're going to have to buy something again, it's going to be really expensive for you. So you need to buy accordingly to the interest rate. I have not seen that much of a drop down where it really, really makes sense to pull it on selling something or buying something. And yeah, it's crazy. It is just crazy. This article also said that that people that refinanced are now in more deep trouble. That refinanced in the 3s or 4s are in trouble because those people now cannot move. So if you refinanced and took some money out or whatnot in the 3%, you did that, and now you're kind of married to your house, just like me, because if you want to buy something else now, you're going to have to pay so much more. So you're kind of in trouble that you're kind of stuck now because you don't want to sell it and then rent or do something else. So and we're not in a way where interest rates are on a decline, where we can clearly see, the recession's hit, they're going to keep lowering interest rates. So you're now stuck. So am I for a few years here. I would not sell this house regardless, but I hope that anybody else that is thinking about that can do something creatively like Airbnb, short-term rental, or long-term rental, and try to find a way how they can do that. Because the worst thing is when you give up an asset and you need to get rid of it because you can't keep the costs going, and in 5 years you have so much more money for it. So yeah, let me know in the comments below what you think. I think this article is pretty accurate, and I will see you in the next one.